Welcome back to the deep dive. Today we're digging into, well, one of the most iconic names out there, a company that for decades defined market leadership.
But right now is trading like it's completely lost its way.
Exactly. We were talking about Nike, Inc., ticker NKE, and the market perception right now, it's just brutal.
It really is. I mean, if you look at the stock, it's hovering near 5-year valuation lows. The consensus, the main story out there is that this is a broken compounder.
A broken compounder. And the argument is what? That they've lost their cool.
That's a huge part of it. The idea is they've missed the shift in what people want. They've lost their innovation edge to these nimble upstarts like Hoka and On.
And, crucially, that massive, expensive pivot to direct-to-consumer.
That it was a complete blunder, a total misstep.
Okay, so that consensus is loud. But our job is to test the other side, the variant perception. Is Nike permanently broken, or are we just looking at the painful bottom of a classic self-inflicted capital cycle reset? That's the mission for this deep dive.
And to do that, we've synthesized a number of forensic value investing research reports, the financial statements, of course, and the Q2 fiscal 2026 earnings transcripts. We're looking at the hard data, the operational metrics.
We want to see if the new management team is truly fixing the foundation or if this is all just, financial engineering.
Exactly.
And before we get into the weeds, let's just give you the single most important insight right up front. Here's the signal we think the market is misinterpreting. Despite the headline, stagnation Q2 revenue was up a miserable 1% to $12.4 billion.
Which looks terrible.
It looks awful. But the composition of those sales is changing dramatically. It's like, imagine a restaurant that sold the same number of meals as last year. But last year, 80% of them were high-margin steak, and now 80% are low-margin burgers.
The top line, the total revenue, is flat. But the underlying health of the business is completely different.
Okay, let's unpack that revenue contradiction because it's so important. The flat growth headline is easy to just dismiss as bad news. But when you look under the hood, you see these immediate drastic changes.
Right. So Nike direct revenues, their own stores and website, they fell 8%.
Which is bad enough, but the really shocking number is the digital sales, the core of that whole expensive DTC push.
They cratered, down 14%.
14%. Those are the numbers that terrified the market. It suggests people actively dislike buying from Nike's own apps and websites.
It does. But, and this is the key, at the exact same moment, the legacy wholesale revenues grew. And not by a little.
They grew robustly, by 8%.
That's the whole story right there.
And that's what we're calling the wholesale boomerang. It proves people haven't stopped buying Nike shoes.
They've just stopped buying them directly from Nike.
Right?
Precisely. The core insight is that consumers, well, they prefer the multi-brand environment. Places like Foot Locker, Dick's Sporting Goods, your local running store.
So this pivot back to wholesale isn't a sign of desperation.
I think it's a sign of abandoning the hubris of that consumer direct acceleration push.
Yeah.
That strategy was incredibly capital intensive. It was super sensitive to logistics costs. They're now strategically realigning with where the customer actually wants to shop.
But hold on. Doesn't reversing course after years of telling everyone that DTC was the future, doesn't that signal incompetence? They spent billions building out this whole system.
Oh, it absolutely signals a failed strategy, no doubt. But the realignment itself is the healthy part. They're absorbing the sunk cost of that failure to build a more sound business for the future.
Okay.
And that brings us to the biggest fear the market has right now, which is margins. Gross margins contracted 300 basis points. They're down to 40.6%. And that looks like a permanent loss of pricing power.
Of course it does. If you see a 300 basis point drop, you naturally assume the business model is just structurally broken. So how can we argue this is temporary and healthy? That sounds totally counterintuitive.
Because it's largely an optical illusion. It's driven by two very deliberate management actions. First, they are intentionally killing off excess supply to restore brand scarcity. They're clearing the deck.
What does that mean in practice?
It means they are massively reducing the supply of those classics that they overproduced, like the Air Force Ones and Jordan 1s, by over 20%. They have to liquidate that glut, which crushes margins now, but it prevents the brand from being diluted forever.
So they're buying back their cool factor.
They're buying it back, taking the short-term pain for the long-term brand equity. And the second factor is just their sheer scale. Nike is absorbing temporary tariffs and cost headwinds that amount to, an estimated $1.5 billion?
And their smaller competitors can't do that.
Exactly. The nimble upstarts like On or Hoka, A hit like that would cause them massive financial distress. Nike's scale lets them just swallow the cost and wait out the cycle.
Okay, let's go back to that wholesale boomerang. You said something really interesting, that shifting back to the wholesale channel, which has a lower gross margin, somehow expands long-term operating margin.
Right.
Wait, a lower gross margin is better for the operating margin. Can you just quickly remind everyone listening what the difference is here?
Absolutely. Think of it this way. Gross margin is super simple.
Yeah.
It's the selling price minus what it costs to make the shoe. DTC has a high gross margin, maybe 60%, because Nike collects the full retail price.
Okay, makes sense.
But to get that high margin, you have to then pay massive operating expenses, all the store leases, the staff salaries, the shipping, the digital marketing, processing all the returns. It adds up.
Right, the SG&A.
The SG&A. Now, the wholesale channel has a low gross margin, maybe 40% because the wholesaler takes their cut. But Nike's operating expense is almost nothing. They ship a pallet of shoes to Foot Locker, and they're done.
So the dollar they get from wholesale is a cleaner dollar.
A much cleaner dollar of revenue. It requires far less overhead. So this strategic shift, it shrinks the whole SG&A base, which improves the bottom line operating margin and, most importantly, return on invested capital.
And that ROIC, return on invested capital, that metric is everything when we talk about a company's moat. And Nike's true identity, which I think gets lost in all the noise, is that they are fundamentally an intellectual property and marketing firm.
They're not a manufacturer.
Not at all.
It's the definition of an asset-light flywheel. And the unit economics are, well, spectacular. They leverage low-cost contract manufacturing in Asia against this high-value Western brand equity.
A shoe costs, what, $25, $30 to make?
And it sells for over $100 at retail. The nearly $5 billion annual marketing budget, that demand creation, it creates this IP barrier that should be almost impossible to overcome.
But that failed DTC pivot, it just bloated the entire machine. The collapse in capital efficiencies.
It's truly stunning when you look at the charts.
Huh?
Historically, from 2016 to 2022, Nike was a powerhouse.
An ROIC machine, generating returns on invested capital in the high 20s, almost 28%.
And that is the single most damning chart for the previous management team.
Yeah.
That aggressive DTC strategy, it demanded massive investment, logistics, digital tech, building out physical retail stores.
It bloated the SG&A, it bloated the balance sheet.
And it just diluted ROIC all the way down to roughly 11.5% in 2025. That is a 60% drop in capital efficiency. The entire turnaround hinges on getting that number back towards 20%.
Now let's talk about a quiet little alarm bell from the balance sheet. A critical red flag the forensic reports really honed in on.
Yeah, we need a forensic alert on this. It's a potential working capital trap. The metric to watch is Days Sales Outstanding, or DSO.
Which is what exactly?
It's the average time it takes for Nike to get paid by wholesalers after they send an invoice. Historically, Nike collected cash really fast, around 30 to 33 days. Recently, that has ballooned to about 43 days.
So what does that mean in practical terms? Why should you care if it takes them 10 days longer to get paid?
It's a classic, subtle sign of stress. If your revenue is flat, but it's taking you longer to collect cash, it suggests your customers, the wholesalers, are struggling to sell the inventory you just sent them. The real danger here is something called channel stuffing.
Ah, channel stuffing. So that's when
Nike, the manufacturer, pushes a ton of inventory out the door to their wholesalers right at the end of a quarter, just to hit that quarterly revenue target. They might offer easier payment terms to convince the wholesaler to take the product.
So that 8% rise in wholesale revenue might not be real consumer demand.
It might be a temporary loan of inventory to the channel. And if that's the case, if retailers are now choked with unsold Nike product, the company's going to have a very, very painful hangover in the coming quarters.
And that ties right into this inefficiency tax we identified. In Q2, their marketing spend demand creation, it spiked 13% to $1.3 billion.
Well, revenue only grew 1%.
You're spending aggressively just to stand still.
It's exactly. Management calls it a necessary investment, but fundamentally what it tells you is that the cost to stay relevant has structurally increased. The brand just needs more fuel to maintain cruising altitude.
So if the problem was operational inefficiency and a failed strategy, the solution really has to be management. And let's look at the catalyst here, the leadership pivot. It really feels like they're moving from a spreadsheet manager back to someone who actually, leases up the shoes.
That's the perfect way to describe it. They're transitioning from John Donahoe, who was the technocrat, the guy optimizing for algorithms and the income statement.
To Elliot Hill?
To Elliot Hill, the shoe dog. A product-focused veteran. His whole job is to restore the culture, to shift the focus back to winning by sport, by category, not just by e-commerce channel.
And the tone from management has completely changed. I mean, you read the transcripts and the bravado, the hubris in the last few years, it's gone.
It's humility. They're intensely focused on operational blocking and tackling. And truthfully, they have explicitly said to expect more near-term pain. They're forecasting Q3 gross margins to drop even further.
Which Wall Street hates.
Wall Street hates it. But for a value investor, that willingness to take a big bath right down, to sacrifice short-term earnings to get inventory healthy for the long run, that's a huge positive signal.
Yeah.
It tells you they're managing for the next 10 years, not the next 90 days.
And you can see this shift in how they're spending money. That massive $4 billion plus marketing budget is being reallocated.
Exactly. They're moving funds away from that expensive and frankly ineffective digital customer acquisition that fed the DTC machine.
And putting it back into
Traditional sports marketing, athletes, event sponsorships, high-profile collaborations. That hits the income statement immediately as an expense, which creates this temporary earnings depression, and that's what offers the current entry point.
And it's amazing that even through this massive reset, their shareholder alignment has remained pretty robust. They have, what, 24 straight years of dividend increases?
And it's now approaching a 3% yield.
Yeah.
And you also have to give them credit for how they manage the share count. Look, stock-based comp, which was around $709 million, that's a real economic cost. It dilutes you as a shareholder.
Right.
But Nike has used massive buybacks to counter this. They've aggressively reduced the share count from 1.69 billion in 2016 down to 1.48 billion in 2025. They're using capital returns to fight dilution and return value. It shows discipline.
All right, now we have to apply Charlie Munger's favorite trick, inversion, the pre-mortem. Let's assume Nike fails. 5 years from now, the turnaround is a bust. What happened?
The cause would be one of the big structural risks, the ones that the current pivot was just too little too late to fix.
Okay, risk number one has to be the innovation trap. We're calling this the Nokia moment. Nike's whole identity is performance innovation.
And they missed the biggest running trend of the last decade.
The Max Cushion trend. Hoka and On basically ate their lunch. Nike was late to that party.
And that is the most lethal risk, a permanent structural loss of the innovation edge. If the new updates to their core running shoes, like the Pegasus or the Vaporfly, if they fail to stop the slide, the brand risks becoming just a lifestyle company.
And that's a much lower multiple business.
A much, much lower multiple than a performance IP house that drives the cutting edge of sport.
Okay, risk number two is geopolitical. The China decoupling. China is about 15% of revenue for Nike, but in Q2, revenue there fell 16%. Digital was even worse.
Digital was down a staggering 36%. The failure mode here is the structural rise of guachao, that nationalist consumption trend that favors local champions like Anta and Lining.
So Nike becomes a political football.
It becomes a political pawn, and a massive historical growth engine for them just evaporates. You can't just replace 15% of your global revenue overnight.
So we've laid out the risks, we've laid out the turnaround case. Let's bring it back to the money. Is this stock actually a bargain today? We have to run the valuation reality check.
Okay, so if we use an owner earnings calculation, which, strips out accounting noise to show the true cash profit, Nike's trailing 12-month owner earnings are about $2.79 billion.
And at the current market cap, that implies an owner earnings yield of only, what, 3.3%?
About that, yeah. Only about 3.3%.
And that is, well, that's rich compared to the risk-free rate. The 10-year Treasury is sitting around 4.2% right now.
Correct. So on its current depressed earnings, the stock is fairly priced for a turnaround. It is not a screaming bargain. The market is already pricing in some expectation of recovery.
So the bet you're making?
The bet you are making is that this strategic realignment works, that owner earnings recover, and that 3.3% yield effectively doubles over time, giving you a much more attractive yield closer to 7%. So to synthesize this whole thing for you, Nike is not a deep value stock, not in the classic Ben Graham sense. Trading at, roughly 24 times depressed earnings is just too high for that.
So what is it?
It is fundamentally a quality turnaround play. The safety here doesn't come from a rock-bottom valuation multiple. It comes from the sheer proven durability of the brand, their scale advantage, and the fact that the balance sheet is net cash strong.
The numbers are fascinating, though. If the new CEO, Elliott Hill, if he does pull this off, If they restore normalized earnings and they only achieve a conservative 5% free cash flow growth annually,
which is very conservative compared to their history.
right, then the intrinsic value, based on that model, it jumps to over $104 per share. And that shows some significant upside from where the stock is trading today.
The whole setup is clear. You're buying short-term pain, the margin pressure, the strategic pivots for the potential of the long-term compounding power of this iconic brand.
So here is the provocative thought we want to leave you with. The core question isn't really about PE ratios or logistics. It's whether Elliott Hill, the shoe dog, can make a 50-year-old brand cool and innovative again. You are essentially buying a call option on his ability to fix the operations and restore that cultural magic. Can he reignite the innovation cycle, the next Air, the next Zoom X to fight off these nimble upstarts? Or is a Nike just the world's largest, best-marketed retirement home for classic sneaker franchises?